Folks, we are live. Welcome to Monday Night Stock Charts Live. Happy President's mute. I had the mute button on. Welcome, folks. Happy President's Day, formerly known as Lincoln's birthday and Washington's birthday. We haven't forgotten them. I believe it was Martin Luther King holiday that replaced both their was consolidated President's Day to make room for Martin Luther King Day, but he was a great man, so I'm okay with that. So let's get to it. Let's talk about the opening futures action. Now, the thing to remember here, folks, is that the markets were open today. At least the futures markets were open today. And you're seeing a little bit of catch up right now in prices. The futures were up on the day, closed up on the day. They're opening up fractionally on the day. Actually, it looks down to me. I'm not sure what's going on here. It looks down to me. But be that as it may. Not much volume here at all. Thank you, Franklin. NVIDIA earnings on Wednesday. Fasten your seatbelts. Yeah, it's going to be a big day. We're going to talk about that more in a moment. Hey, Larry. Joel, happy birthday. Happy President's Day. Maybe we'll get another decent one in my lifetime. I hope so. I hope we get plenty of them. Trader Isaac. Welcome, my friend. Okay, so E-minis are open. Not much happening here. I think this is wrong. It looks like we're opening down after closing out the abbreviated session up on the day. Let's go to the NQ. That's the NASDAQ 100. And they appear to be opening down as well. Again, you're going to have to ignore this percentage gain because it looks like we are down relative to the close at around 1 p.m. Eastern Standard Time. As for the Russell 2000, they were down today significantly. And one of the reasons for that is, as I mentioned on Best Stock Charts for the new trading week, was that I was worried about yields. And I think yields popped up today. They were down early on. They closed up on the session. So a rough day for the Russell, but it looks as though they're trying to regain some of that lost territory. Taking a look at the mid-cap sector, looks like they closed up on the day. Very, very odd day today to have the small caps down so much. Mid-caps look like they closed up along with the mega caps. Strange day. But thin volume, a lot can happen. Let's move on to the U.S. dollar. Now, the dollar didn't do much today. And we are opening the session trying to rally. This is a 5-minute chart, trying to rally. I want to step back here for a moment because One of the topics of today's show is going to be if we do get a correction in the equity markets, and I'm talking about a serious correction, not a 5-10% correction. I'm talking about a serious correction. Is Bitcoin and or gold a safe haven? Simple question. So we're going to take a look at those two names in a moment if, in fact, we do get a major correction in the equity markets. Now, one of the contributors, I believe, to any decline in the equity markets is an overly bullish U.S. dollar, and we've had that, but it appears as though we peaked out a little bit last week. Now, at current, on a, let's go to a 4-hour time frame, go a little bit more high level. I'm looking for consolidation and then a breakout here on the U.S. dollar. Now, the reason why this matters is that if you have a strong U.S. dollar, means you can keep somewhat of a lid on commodity prices. And we're seeing commodity prices of late begin to move up higher. And that is, of course, inflationary. So the dollar is in a trading range. I want to be bullish on gold. I really do. I'm seeing a good setup here on gold, except I can't pull the trigger to the long side to get aggressive with gold. We already own some gold. I can't get aggressive until we see a break in the U.S. dollar. But right now, all I'm seeing is a threat of a higher low and a breakout to a new higher high. Therefore, what do we need to do? We take these two things right here. When we feel compelled to do something in the equity market, we take our two hands and we do this. We sit on them. We don't do a goddarn thing, not a goddarn thing until the time is right. So moving on to go back to a 5-minute chart, moving on to how precious metals are responding to a dollar, which is up a little bit. Let's check in first with gold. I was watching it a little bit today, and it showed strength. Now, what I want to point out on gold, I'm going to go to a different study here. And what I want to show you is an interesting setup where you have on a I want to get rid of this. There we go. On a weekly chart, see these orange bands here? These are your Bollinger Bands. And your Bollinger Bands on a weekly time frame are now trading within these white lines here. These are your Keltner channels. And what you're seeing form here is a Bollinger Band squeeze setup. Does this mean you go running out tomorrow and go buying gold? No, 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 no. But what it means is that you watch very, very carefully. You watch for inverse correlations to correct. So if you have a correction in the U.S. dollar, one would expect a rally in gold. But right now, the dollar's looking a little bit too strong. Therefore, we're going to acknowledge the fact that gold is going into a very, very tight compression zone, but we're not ready to pull the trigger yet. We're going to be there very aggressively, but things have to happen first, a series of things, and I'll go over that with members as things develop. But first of all, we need to have a correction in the U.S. dollar. That is a non-negotiable. So gold on a weekly chart, setting up for a Bollinger Band squeeze on a daily time frame. Same thing, getting close anyway. We were there a couple of a few weeks ago, but that failed. It actually broke down. So no rush here to go getting long, more aggressively long of gold, but that weekly chart is firming up really, really nice. Now, getting back to current day pre-market activity. Gold is up fractionally. Actually, this looks down to me versus the close. So these are all numbers are all off. So don't pay attention to these percentage changes here. Watch the chart. In shaded is after hours trade. I guess that's what they're going by. No, it can't be because it's down. I'm not sure how they're measuring this, but this is wrong. It's technically down relative to the pre-market or the regular hours trade for the day. Now, looking at silver, silver had an up day, but fading. So not a great open here for silver. Looking at energy prices, okay? Energy prices are down. This is light sweet crude, which has been very, very strong of late. I'll show you a chart, a weekly chart of oil. We broke out here the week of the 22nd of January, failed the week of the 29th. Rebroke out on the 5th, continuation breakout last week. This week, no new weekly higher high, but I predicted that we are going to break out. So beware here. Oil prices are very, very strong. And when you take a look at gasoline prices, that's a greater concern to me because, as I just mentioned with gold on a weekly chart, you have the same thing setting up here, Bollinger Bands within the Keltner channels on a weekly time frame. We closed down last week. We're opening down this week, but this week back here, the week of the 5th of February, that was a 19% gain on the week. So what we do here is that we're going to let CNBC and other pontificators on YouTube come out and say what the CPI said last read, which is very, very hot. We don't care about that. That was last week. That's old news. Now what we're focused on is the CPI report that's coming out next month. We're getting ready for that report now. This is why we're doing what we're doing. We're looking at gasoline prices, oil prices, food prices to get a feel for, okay, which way might the dollar go? Which way might yields go in preparation for a hotter than expected CPI report? Simple as that. Because when that news is released, it's already old news. You need to be positioned in advance of it. So gasoline prices are very, very, I'll say threatening right now, threatening a breakout here and a measurable breakout at that. So where I'm a futures trader, I throw a couple of contracts on here to the long side. Home heating oil. This broke out back here the week of the 8th of January, and all we've been doing is going up. So it's a slow and steady rally on home heating oil. So we can conclude, I'll go back to light sweet crude for a moment. We can conclude here that what we're seeing is, in fact, inflation at the energy level. Again, we broke out the week of the 5th, continuation breakout last week. Charts don't lie. And this is all, again, inflationary. Now, as we segue over into the copper markets, we're just getting a feel for global economic growth. Is there growth? You would know by Dr. Copper. And Dr. Copper is just hanging out here, consolidating nicely, but not doing a lot of much. Now, looking at agriculture and protein in terms of live cattle, I mean, what can you say here? I mean, pardon my pun, it's a bull market. We are very close to breaking out to new higher highs on live cattle. Looks like it's going a lot higher. Now, staying with the theme of protein, take a look at this move up higher so far this week. Oh, excuse me, last week on hogs. This is about a 5% move on hogs in 1 week. It's a big move. So protein prices, energy prices moving up higher. Let's segue over and into a view of agriculture. Excuse me 1 second. Sorry, folks. I just got approved for a new tranche of life insurance at my age. Pretty good. Okay, so I had to make sure that I took that call. I apologize. Um, let's check out agriculture. Now, agriculture is a safe haven here. Not a safe haven, that's an improper terminology, meaning safe haven from inflation. Right now, corn prices are just getting annihilated. However, prices at the store keep going up. Isn't that strange? Soybeans, annihilated. Wheat, annihilated. So, agriculture is a breath of fresh air, but only if we would see some reprieve in at the supermarket. Now, I skipped over this. I know somebody mentioned this earlier in the chat. Nat gas. So, nat gas, what we're looking for here is a trade off the 1.51 mark on nat gas. We last tick on nat gas is 1.56. So we have a little bit more ways to go. I'd like to see an overshoot to the downside. If we do a bullish key reversal bar and close back above 1.51 on natty gas, we're probably getting long of natural gas vis-a-vis oil. This is a leveraged product, not for the faint of heart. If you don't have a futures account and you want to buy an ETF, use UNG if you don't want the volatility. So I think that this is setting up nicely for a bounce soon, but there could still be more downside here. And natural gas is a commodity that they like to call the widowmaker. So please respect it. Do not get too big in any one position. In reality, that's the only thing in this market that we can control is our position size. I think that covered what I wanted to review. Let's do a quick check of yen. No new weekly low yet. I want to check out the euro because the euro bounced last week, still closed down. Yeah, you could see the bounce last week. So I'm wondering, are we putting in a floor here on euro? And do we break out? Now, if we do, this prior support level now becomes resistance. Now, I spend a lot of time on the euro because it's the biggest counterparty product to the US dollar. The second comes is yen. If you get euro yen moving up, dollar's going down. And that's the reason why we spend so much time looking at this, because what does this homework do? All these have an interplay, right? If we want to buy gold when the dollar breaks, well, how do we determine whether or not the dollar is going to break? We need to see the strength of euro yen. Euro yen right now sending mixed signals. Euro is basing, yen a little bit still wonky. So we're not confident yet in opening up or adding to a gold trade. But I want to. I want to badly. Okay, let's take a look at fear and greed. And I hate to use CNN for anything, but they actually have a pretty good product here. I've tracked it in the past, and it's pretty reliable. So I'm going to go through it, which is a good graphic. So as we're going into the new trading week, what's the structure? What's the structure of the market? Do we have a lot of optimism, pessimism, moderate? Do we have a wall of worry to climb here? No, we have a lot of greed. We have a lot of optimism in the market. And as a contrarian, I start looking in the opposite direction. Now, we've been bullish for a while now, and there are signals out there that are telling us not to get short, not to get short. Yes, we did shorts last week, did okay with them. We still have a couple of shorts on SMCI. We still have a short there, actually more neutral now. But we're not net short. I'm not ready to get net short yet. If anything, I would be biased long with a neutral position on the market, just collecting cash flow. So that's my take on it right now. Am I the least bit surprised if we break out to new higher highs tomorrow? No, we don't have much in terms of overhead supply in the equity market. In fact, we're very close to all-time highs. So the path of least resistance remains unchanged for now. But we're going to talk about the reality of what we're living in this snapshot in time. It's been 3 days. Friday was a long time ago. We're going to go over the news over the weekend. We're going to remind ourselves with the dysfunction that this country is in very briefly, so that way we get our minds right, because we know that this dystopian hellhole that is forming in this country, at some point in time, the chickens are going to come home to roost, especially in an election year. So as we scroll down here, we know the sentiment of the market is overly greedy. Bad things can happen. Momentum, pretty strong here. Breadth, a little bit wonky. When you take a look at this, you want to see breadth broadening out, meaning very high. You have a broad base of stocks that are moving the equity markets up higher. This is improving over the past few weeks, but it's not where you want it to be. It's not as broad-based as you want it to be. That 60-40 portfolio, that's 60% stocks, 40% bonds, that's not treating you very well right now. Now, this is the one that I look at quite a bit, and that is the put-call ratio. This just validates what we're seeing here, extreme greed. What this measures is the number of puts that are being purchased relative to calls. When you get an over exuberance of buying of put options, well, you're probably at a top in the equity markets, too much fear, and vice versa. So right now, you have a lot of call buying going on. You saw that with SMCI last week, a ton of it. And sure enough, that thing went on Friday. So the other one we want to take a look at is volatility. This is the VIX. And there's a saying that when the VIX is low, you got to go. When the VIX is high, you got to buy. Now, the thing is, with the VIX is low, you got to go. It could stay low for a while. I've seen VIX down in the single digits. Do I think that's where it's going? Probably not. But it's been down there, and it's stayed down there for a while. So we have VIX, at around 14 handle right now? It could stay here for a while longer. So by no stretch of the imagination am I coming on here tonight to preach doom and gloom. We're going to crash tomorrow. That's not what I'm saying. I'm just saying buckle up, get ready if. And then we're going to talk about what does well in that type of sell-off environment. Now, looking at the economic data coming out this week, we're going to have leading indicators coming out tomorrow. That's more Federal Reserve driven in terms of their forecast of the economy. We're going to have a lot of Fed heads coming out this week, Bostic, Bowen. Then we get the FOMC minutes coming out on Wednesday at 2 p.m. Thursday, weekly initial jobless claims. We're going to get U.S. Services PMI, Purchasing Managers Index. Now, this has been able to hold above 50. That's just a sign of expansion. A read below 50 is a sign of contraction. Now, manufacturing is below 50. It's been below 50 for over a year now. Do services remain in an expansionary environment? We'll know this week. More Fed heads coming out later in the week. So buckle up. There's a lot going on this week, and it can move the market. Now, looking at valuations going into the new trading week, we're not cheap. We have a trailing PE on the S&P 500 at 33.69. Pretty expensive relative to the mean of 17. Now, looking at forward guidance, here we go. The forward 12-month PE for the SPX of 20.4 is above the 5-year average of 19 and above the 10-year average of 17.7. So we're expensive on a forward-looking basis as well. So this is a market that is susceptible. It's susceptible to bad news. And I'm going to go over what I believe to be the biggest piece of bad news for the equity markets in a moment if it pans out. And my fear is that it's going to pan out. Now, looking at the CME Fed Watch tool for March, that's the next Fed meeting, there will be no rate cut. So for anybody out there that's still pontificating about a rate cut in March, it's not happening. Move on. You can go out to May. Okay, let's go to May. This was at 80% at one point in time. That ended last week with the CPI report and then again the PPI report. Now we're down to 35% probability of an ease. So right now, take June, cross it off the page. What about, May? What about June? Still strong possibility of an ease, but that's several meetings away. And we have a lot of economic data to get through between now and then. Now I'm going to go back to this for a moment. So I was watching a podcast with Josh Brown. He's a fellow New Yorker of mine. He's over at Ritholtz Capital, and he was getting interviewed, and he said something interesting that initially I scoffed at, and then I tried to keep an open mind. I said, let me think about this. And then I said, you know what? He sold me on his idea. Because the question was, why is the market rallying with the probability of rate cuts evaporating? And his answer is that the market right now is satisfied with a pause. It's been satisfied with that for a while because we had that huge amount of rate cuts, then the pause happened, and then we moved up higher in equities. So the markets are still thriving off of that pause, and I'll buy into that. The question is, what happens if yields break out? Think about it. We'll go to a chart in a moment. Earnings coming out this week. Tomorrow, we get Walmart, Home Depot, big retail tomorrow morning. Barclays Bank coming out tomorrow morning. After the close tomorrow, Palo Alto Networks, great stock. Caesars reports, Toll Brothers reports. And the Pimp Mac Daddy of the week by far is going to be NVIDIA. No doubt about it. Watch out for Rivian. That could impact Tesla. Etsy comes out, good trading stock. Lucid, another EV company, comes out. Thursday, Moderna. Cheniere Energy. Fiverr. I spoke about Fiverr over the weekend on best stock charts for the new trading week. Go check it out. After the live stream, of course. Blocks, formerly Square, Carvana. I'm surprised they're still in business. What else do we have here? Later in the week, Warner Brothers. Not much going on. I mean, really, it's all about Wednesday. Wednesday's the Pimp Mac Daddy. So watch out for NVIDIA. We're going to talk more about NVIDIA's chart in a little while. Moving on to, I hate when it does this. So this is from Sven Henrik, and he posts some good stuff sometimes. And it's really good to refresh yourself with the so-called professionals that are out there. And he posted this on the 18th. 2000, Washington Post. Economy seems headed for a soft landing. 2007, March 2007. Economist, jobs report confirms soft landing. How many times have you heard that lately? 3 weeks ago, IMF says global soft landing, again soft landing, Insight lifts 2024 growth outlook. They always get it wrong. Now, as a refresher, as we go into the new trading week, this is the condition of this country at this point in time. This is the world's leading democracy. This is in my hometown, New York. This is communist China. What's wrong with this picture? But this is the world we live in this country right now. Absolute dystopia. I'm going to play this for you.
Here is the Row Hotel.
This is one of the 5 hotels that has been transformed into a shelter.
So we're going to walk in there and see what kind of operation they're running inside. This is a really nice hotel. How's it going?
How can I help you with?
Oh yeah, we were just checking out the hotel.
Oh, the hotel is closed, I'm sorry.
It's closed, but there's a ton of people in here right now.
Because it's a shelter now.
Oh, you guys,
Hotel.
it's shelter for the migrants coming in?
Yeah, it's no longer open to the public. It's closed to the public.
How many floors is it?
30.
30 floors. This thing is,
Yeah.
you guys aren't allowed to talk about it?
Yeah.
Why is it like such a big secret, do you think?
I don't know. We just follow orders.
When hotels such as the Row Hotel close until further notice, they sign a contract with an outside source saying that they will pay the rent in order for them to house the migrants. And the hotels love it because it is guaranteed money every single night. And at a rate of $200 per night at the Row Hotel, and with 1,331 rooms, that is $260,000 a day, $1.8 million a week, and $7.2 million a month. And all that money is guaranteed.
Now, I'm telling you right now, I've stayed in Manhattan a couple of hundred times, and $200 a night is nothing. It's very, very cheap. And then with the taxes they throw on top of it, add another third in taxes on top of it. And this is the city that's supposedly paying for this, and this is our subway system. So, a reminder after a 3-day weekend, what we're coming into this new trading week. Our leadership is corrupt, and something's going to happen. Something's going to break here at some point in time. You got to be ready. Pentagon confirms, this is over the weekend, Pentagon confirms $32 million drone downed off of Yemen. Same day UK tanker destroyed. Again, the Red Sea. Major problem. And what does that mean in the Red Sea for us plebs, us useful eaters, as the World Economic Forum likes to call us? Take a look at freight rates since 2023, up 106%. So let's play the game. Let's play the game here. Okay, so, the average person sitting at home, not you folks, because you're here on a Monday night getting ready for the next business day. But the average person at home playing video games, they don't care about this. If they saw this chart, they wouldn't think twice about it. They'll think to themselves, that's somebody else's problem. When in reality, these are going to be charged to us. These freight rates are going to appear in next month's CPI report. They're not going away. They will be absorbed by the consumer. It's a foregone conclusion. Did you see the PPI report, the producer price index report from last week? That's where it appears first. Continuing with the Middle East, war expands, massive Israeli airstrikes 60 kilometers deep into Lebanon. Expansion. Come on, X. Jesus Christ. This is not where I wanted to go to. This is today. What happened to it? Well, I don't have the. I lost it, I guess. The Chinese plunge protection team had to get involved today with the markets. I had this up here. And that could be a part of the reason why we're seeing a muted response in the equity markets and why such a sluggish day today in the futures action. And Chinese EV prices, we're going to talk about Tesla in a moment. EV prices are falling off of a cliff. Nobody wants them. There are photos coming out of China of fields full of EV vehicles. They were supposed to be robo-taxis. Now they're junk. They're just rotting in a field somewhere. Thousands of them. Bank credit contracting sharply. So banks are tightening up credit. Although I got to be honest with you, I keep getting credit card offerings a dozen a day, constantly, sometimes 2 by the same bank every single day. Now let's talk about yields. All right, so we went through the threats that are out there in this economy, in this globe, what appeared over the weekend. Now that we know, we kind of got an idea of, okay, we're 3-day weekend's kind of over here, and now we got to focus on tomorrow and what matters to the equity markets. What really matters to the equity markets? Initially, you could chalk it up to one chart. One chart only. And that chart is the 10-year yield. And if we break out and close above, let's call it a 4.4, 4.5 handle. Let's go with a 4.5 handle. That's more of a roundish number. I think that you're probably going to see initially the small caps, which have been doing pretty good. I'm positioned there. They were down a 0.5 percentage point today relative to the mid caps and the large caps. What did yields do? They closed up. Then I think you see the mid caps roll over. Then I think you see high tech beta roll over. And frankly, high tech beta has already begun to roll over. Stick around. I'm going to go over a chart. So this is a weekly chart, 10-year yield. Big up week last week, up by over 2.5%. We had broken out the week prior to last, continuation breakout last week. Do we break out this week? That is the big question. If we do, buckle up. Let's check out the pre-market action with the 10-year yield. And we are up by nearly a 0.5 percentage point on the session. We are yielding at current on the 10-year yield, pretty decent chart, 4.3 handle on the 10-year yield. Now, we go by closing price action, not intraday price action. So until this closes above 4.4, 4.5, I'm not going to worry about it too much. Right now, though, I'm not worried, but I'm watching it. So keep an eye on this chart. Very, very important. Talon. Hey, brother. Okay. So let me explain what this is mislabeled. So I want to explain this to you. I'll read this off. The direction of yield. See, he's got this right here, but this is mislabeled. So I'm going to explain it. The direction of yields continues to matter more to equity valuations now than at any point over the last 2 decades. True. Now, keep in mind, he's got this 20-plus year Treasury bond ETF. That would be the TLT. What he's supposed to mean here is the 20-year yield, 20-year bond yield, not the TLT. So yields have been rising up relative to the equity markets, and we are at a highly correlated rate not seen since, since 1904? That can't be right. Wow. This is a great chart. So that's one view. Another view of where we're at on the curve, I normally go over, and I'm going to go over it in a few minutes, 2 years versus 10-year yield curve inversion. Now, this is the 10-year versus 3-month. It's supposed to be 3-month versus 10-year. But anyway, we are at lows not seen since, we're at the same level. We went lower back in 1980s, but we're at the 1929 levels. Of course, we had a stock market crash back then. But again, as I've said in the past, this is not to be hyperbolic. You got to worry about the steepening of the yield curve, not the inversion. When it steepens, that's when you worry. Right now, you can't read much into this. When it steepens, that's when you get worried. As a matter of fact, this uninverted not too long ago, but I think it's reinverted again. Now, this is off of All-Star Charts. JC shared this out. And the one I want to go over is this one here, this chart here. Now, I mentioned earlier that with rising yields, you need to worry about high-tech beta because they are naturally high PE names. They're growth names. They have a lot of debt at times. They need to go to the open markets to sell shares to raise capital. They are more susceptible to rising interest rates because it impacts their margins and their EPS. So what's technology doing versus the S&P 500 at current? And JC puts out a great chart here, and that's the ratio chart. Again, XLK, the technology ETF, versus the SPY, the S&P 500. And you can see what's gone on here is a double top. Not only that, JC's got a support level here at a prior high. I would argue that you should probably be using the prior low because now we've broken down below it. Either way, six to one, half dozen of the other. Great chart. What is this telling us? We're breaking down on technology relative to the S&P 500. Does that mean the S&P 500 crashes? No. It just means as long as yields don't go skyrocketing up higher or plummeting, the S&P 500 can move up higher. You may be saying, whoa. I can understand if yields skyrocket, that's bad for stocks, but why would yields declining rapidly be bad for stocks? The reason is that something happened. Geopolitical risk, some sort of fear that caused a lot of money to come out of the equity markets to go into the bond market to seek a safe haven. Now, going back to this chart here, also pointing out that, and I've gone over this with members on a bunch of charts, you've seen this bearish divergence on ultimate oscillator, RSI, stochastics, on trip Qs, a bunch of other charts, XLK, I know we've done as well. And momentum on the 14-week, this is your out-of-the-box RSI, 14-week RSI, putting in lower highs on price. But where are we going on a relative basis over the past couple of months? We've gone higher. So we have a failure of RSI to confirm the higher highs on technology versus the S&P 500. In short, folks, technology is breaking down on a relative basis. That brings us to the Magnificent Seven names. And we're going to spend a couple of minutes here. And I want you to keep in mind, we have NVIDIA coming out this week, and they're going to be reporting. So for those not familiar, to keep it simple, we have a very diverse audience here. We have people that are brand new to trading. We have people that are experienced and professionals. So give me a little bit of rope here so I can help those that are not as educated. So you have your Magnificent Seven names. Used to be the FANG names. So your Magnificent Seven names are Microsoft, Amazon, NVIDIA, Apple, Tesla, Meta, Alphabet. Now, at a bare minimum, two of these names have already begun to break down on a relative basis versus the S&P 500. If you're wondering what those names are, Tesla and Apple. Apple is the second largest weighting in the triple Q names, Microsoft being the number one weighting. I got to check Google, and I also need to see Amazon, because Amazon, I don't think, has broken out to new higher highs. So here you have, this is how big these names are now. So annual revenues and projections of the Russell 2000 versus the Magnificent Seven. Magnificent Seven in purple. In blue, Russell 2000. You have seven stocks with in aggregate revenues projected to be higher than the entire Russell 2000 in 2024. That's mind-blowing. Think about it. So you have such a huge concentration of business. One might argue, are there companies that should be broken up right now? If you have seven companies that are larger than 2,000 of the smallest companies, could there be unfair trade practices going on here? Monopolistic trade practices? I'm not an attorney. I'm not making a decision here. I'm just saying that the FTC should be looking at these companies and saying, okay, we have a lot of work to do here. Maybe they don't. I'm not that smart. Now, looking at the EPS growth of the Magnificent Seven. Now, keep in mind, these are the names driving the equity markets up higher. But on a relative basis versus the S&P 500 for Q4 of 2024, on a relative basis, again, relative to the S&P 500, their earnings are going to decline, whereas the S&P 500 X Magnificent Seven are going to rise. So while I want to make this perfectly clear, this is not a commentary. This is not a live stream about how I'm predicting a stock market crash. What I'm predicting is that sector rotation. All right, we've been talking about this. I've been talking about small and mid caps breaking out, and they have broken out. They did really well last week. The Qs, the triple Q names relative to the S&P 500, there's not much change there lately. So as long as yields do not skyrocket up higher, and hopefully they just trade sideways, mid caps, small caps, they go up. That all changes on a weekly breakout, which it appears like it may be happening right now on the 10-year yield. Without the Magnificent Six, S&P 500 would have declined in 2023. Magnificent Six include Apple, Amazon, Google, Meta, Microsoft, NVIDIA. Tesla is not included. There would have been negative. Think about that. Think about that when we talk about the PE ratio of the S&P 500 being at nearly 34 on a trailing basis and being expensive on a forward-looking basis. And analysts have cut their earnings estimates. So here you can see net revisions on earnings moving forward are dropping. 6-month leading change in economic indicators, while pressing up higher, remains in a downtrend, as do earnings forecasts. So the picture that we have drawn here is that if we get any move up higher in yields relative to, not even relative, above 4.5%, God forbid we take out that 5 handle on the 10-year yield, I think that this market is going to tank. Simple as that. To avoid that, they may jawbone the bond market a little bit, threatening rate cuts, maybe June, maybe July. Perhaps the Federal Reserve will stop rolling off debt as it did last week off of their balance sheet. They'll play games before they have to pull the trigger and do rate cuts. But if the 10-year yield moves at or above a 5 handle, look out below for the equity markets. We trade around there. I think that we could still have a wall of worry rally on the equity market. Why? We're at all-time record highs. And the computers can keep pushing up this market on light volume for as long as they want. Why? There's no overhead supply above. Who's going to sell? Some profit taking? That's about it. Now, looking at names out there that have already, out of the Magnificent Seven, that have already broken down. This is a ratio chart, Tesla versus the S&P 500. I keep hearing people wanting to buy Tesla. Why would you want to buy Tesla? It's broken. It's broken. On a relative basis, Tesla is a broken stock. You're better off buying the S&P 500. You're going to get a better return. This is a downtrend. We've been in the downtrend for quite a while. A lot of overhead supply on Tesla. Another name out there is Apple. Apple is a basket case. It's getting crushed relative to the S&P 500. It's down on the year. Amazon. Last week, it underperformed the S&P 500. By and large, on the year, it's been trading with the S&P 500. Not outperforming. Amazon has not broken out to new all-time highs. Google. Breaking down relative to the S&P 500. So let's go back to this for a moment. The Magnificent Seven, which have driven this market up higher for the past couple of years. Amazon, out. Apple, out. Tesla, out. Alphabet, out. Those that are still standing, NVIDIA, Microsoft, Meta. That's it. Of these names, you have Jeff Bezos selling a ton of shares. Zuckerberg sold a ton of shares. And you have Bill Gates. I think I have a chart up here. I'll show you in a moment. As a matter of fact, I do have it here. This is the selling of Bill Gates. I believe this is out of the Bill and Melinda Gates Foundation. He reduced his position in Microsoft. All these names, I can't read them all off. Even in Berkshire Hathaway. Apple. Look at all of this selling that Bill Gates is doing. A lot of politicians are selling as well. So what do they know? They know to get ready. There's something very, very wrong, which we've been talking about. All they're waiting for is the catalyst, which they may already even know. Now, what's driving up the market at current? Simple. Ratio chart, NVIDIA versus the S&P 500. dragging the S&P 500 up. Now, I don't even know what this chart's supposed to be. Now, looking at the yield curve. All right, so as far as I'm concerned right now, you got to be long the market. You got to be long the market, at least neutral, generating cash flow. I think right now, if you're shorting the market, you're probably a little bit too early to the party. At least I would short individual stocks. I would not short the indexes. They're at all-time record highs. They haven't broken down yet in earnest. There will be a time, I'm just not there yet, to go shorting the overall equity markets, whether it be small caps, mid caps, large caps, Qs, whatever. Not there yet. Individual names, yes. Extreme overbought names, Eli Lilly. That came up on my screen over the weekend. What else? We already did SMCI. What's another one that's out there? There's another one out there. It'll come to me in a moment. But I was going to put it on my list of stocks. As a matter of fact, I have it right here. GE. Daily chart, GE. I thought I was losing it. GE, not General Dynamics, GE. RSI on GE, 87. Shooting star formation on Friday. So this looks like it's topping out. Eli Lilly. RSI on a pharma name. Pharma, nearly 91 on Eli Lilly. So this is going to probably peter out at some point in time this week. So I'll probably be in there at some point in time buying put spreads or selling call spreads on Lilly, probably on GE, maybe. Okay, back to the yield curve. All right, so we're not worried about the equity markets right now until we get a breakout 10-year yield and the yield curve moving up higher. So no breakout here. Now, as for the NASDAQ, which has been leading the charge up higher relative to the S&P 500, daily chart, much as what we saw on the XLK, bearish divergence on RSI, bearish divergence on momentum, on stochastics, bearish divergence on price. And in fact, we broke down below the lower band of support on Friday. Now, looking at the correlation, the fuck is this? That's not what I wanted. Here, that's what I wanted. Looking at the correlation of Bitcoin to the NASDAQ, this should be very, very concerning for those that are long of Bitcoin. I was long. I would still be long, to be fair with you. It's not as if I called it a top on Bitcoin and got out. I would still be long. But SoFi, where my account with, stopped doing business in crypto. And they told me, you got to cash out. You got to move elsewhere. So, okay. So I sold out at about 47,000. And you can see here that if the NASDAQ goes, one of the last places you want to be is Bitcoin, because it's a risk asset. It trades pretty much in lockstep with the NASDAQ composite. So is it a safe haven in a market where you have stocks that are very overbought, the Magnificent Seven, which are leading the charge, they're starting to break apart? Do I want to be a part of this index? Do I want to own more Bitcoin? not on speculation. If it's a long-term investment, fine. Dollar cost average in, I would still be in it, to be honest with you. Even looking at this chart, even looking at the ratio charts on the NASDAQ, I would still be in Bitcoin. So it's not as if I would say, get out now. Were I trading it, swing trading it, I would get out. But I'm not. I'm not going to buy it right now because I'd be paying up for it. But keep this chart in mind, because right now this chart of Bitcoin relative to the S&P 500, beautiful, beautiful. This is a beautiful chart. But we got to keep in mind the correlation of Bitcoin relative to the rest of the market. If the rest of the market rolls over, so goes Bitcoin. Now, Bitcoin on a monthly basis, highly correlated to the S&P 500. At current, they trade 88% in lockstep. So let's go back. Yield curve steepens, shoots up higher, probably due to the fact that yields are breaking out. Do you want to buy more Bitcoin as a safe haven? I don't think so, because it's 88% correlated with the equity market. That's not where you want to go. Where I would rather go is into the gold market, because the gold market is, I had this up earlier. Less correlated with the S&P 500 than what is Bitcoin. Would I go buying gold immediately after the stock market sells off? No. Why? It's because when you take a look at this yield curve chart, I know this is a lot of squiggly lines here, but bear with me. So these blue lines here each represent the steepening of the yield curve, 2000, 2007, 2020. In gray is the S&P 500. In gold is gold. In black is oil. That's another product you should be looking to buy. Consult your financial advisor. So in 2000, it paid to immediately buy gold once the yield curve steepened, equities broke down. Not so much, actually it did work out well in the financial crisis. Not so much back in 2020. It took a little bit while for gold to recover. But gold, watch it as the equity markets roll over. See, somebody just typed in here. I think this is a knock. You goofing on me, dude? That's okay. He's talking about a nugget of wisdom. About that, trying to undo, looking for an actual nugget of wisdom. Okay. I don't know if you're going to get it from me, pal. I don't know. Hopefully you do. So just watch out for the tight correlation of Bitcoin relative to the rest of the market. Might it recover sooner? I think there's an argument that could be made, because what's different now about Bitcoin? And I don't mean to knock Bitcoin. What's different now about Bitcoin this time around, after the market does go into a correction? It's accepted by the banks. It's accepted by the government now. So perhaps the resiliency that we've seen in the markets, given the fact that yields have moved up higher, will be seen in Bitcoin after the market sells off. It could be a new go-to. Who knows? Maybe. So we'll keep an open mind about it. So this is not a podcast about, or live stream about bashing Bitcoin. I'm not. I like it. What do we got here? Oh, hey, Trader Isaac, ARM chart request. I'll take a look at it. We'll trade with SMCI or NVIDIA on Tuesday. If you're looking at them in the context of AI, they're different businesses. So, SMCI is not a semiconductor play. That's more of a peripheral play, a hardware play, but it is AI. So I guess it could, benefit from a strong NVIDIA earnings. But I would argue that NVIDIA, let's go back to NVIDIA for a moment. Let's talk about it. It's already sporting a PE of nearly 100. And PEs don't matter until they matter. I'm looking to see if I could find any chinks in the armor with NVIDIA. Doji star formation last week. It's a sign of indecision at a resistance level. And you may be asking, why? How could there be resistance levels above? It's easy. You extrapolate out prior highs, and you come about resistance levels. So we could get a trend reversal. I want to point out something that we saw on SMCI as well, and that's that we've been trading above the 2 standard deviation Bollinger Band up and into the 3 standard deviation Bollinger Band for the past 6 weeks. Not so much last week. We pulled back a little bit, even though we closed up higher on the week. So it looks as though we're losing a little bit of steam here on NVIDIA in advance of earnings. What are the market makers anticipating here? Wow, we pulled back on yields. Okay, I thought we popped up significantly higher. Sorry about that noise. NVIDIA. So IV percentile is what I expected. A lot of speculators in here betting on a big move on NVIDIA. So they're gobbling up probably more so call options, just as they did with SMCI. They're expecting a move on earnings of about $78 a share. That's over a 10% move on earnings. Buckle up, because that could go in either direction. Daily chart. And I'll put it to you this way: if NVIDIA misses, you better double, if not triple, that anticipated market maker move. No doubt about it. It's going to be a bloodbath. And that's going to take the entire tech sector down. It's going down hard. NVIDIA miss, bad. Very, very bad. So, yeah, we're topping out here a little bit. You're seeing a lot of resistance above. We topped out back here on the 12th. No new higher highs on a closing basis since then, or even on an intraday basis. Rolling over on ultimate oscillator. Now, traditionally, this is odd, very odd. Look at the correlation between the 10-year yield. Usually, they don't stay correlated. Usually, there's an inverse correlation between the 10-year yield and NVIDIA. Right now, they're correlated. Again, we spoke about this earlier. We brought up that chart earlier about the correlation between equities and the 10-year yield. It's kind of weird. Oh, going back to NVIDIA, we'll wrap it up here. We're over anyway. ARM. ARM. Joel, Bob, do you like long straddles on, say, AMD when NVIDIA report? Joel, you're going to pay a lot of money for those straddles. I mean, I don't know what AMD. Well, AMD, I would probably rather go with the AMD. I see what you're doing. You're doing a vertical play on AMD on a miss or a beat on NVIDIA. Is that accurate? Because I know AMD already reported. I wouldn't do it. So I don't like it. It doesn't mean that it's not a moneymaker, and I'll tell you why I don't like it. So I'm just not spitting out I don't like it. I'll give you the reason. The reason is that the reason why I came over here to take a look at AMD was I wanted to see how expensive the options were. Now, if I saw that I had an IV rank currently at 60 on AMD, down in the teens, maybe even the 20s. I would put the risk on, but what you're betting on here is on NVIDIA and anticipated in excess of a 10% move on NVIDIA. Clearly possible. Clearly possible. Probably, though, to the downside, really doesn't make much of a difference if you're long a straddle on AMD and on NVIDIA. But were the options cheap, I would do the trade. I would like your trade. I like the vertical play on NVIDIA. But the options are so expensive. My worry is that if you do not get a big move out of NVIDIA, you might be thinking, well, if I get a move, well, I'll still be able to make some money on the call side or on the put side, whichever way it goes, if it's in the anticipated market maker range of about $78 a share. But what if after earnings, you have IV crush? Get it? So you have AMD options that are now at a 60% IV rank. What if that drops down to 40, 35, 30 after NVIDIA earnings? And it's an anticipated market maker move range. You're going to lose a lot of money, even if NVIDIA moves 10% in either direction, because you're going to have IV crush. I don't like the shot. You're going to pay too much for the options. If anything, you may want to put on a very tight, very wide call and put spread, opening up an iron condor, maybe something like that, or getting long of a iron condor, something like that. Actually, that would be a butterfly. I'm sorry, a butterfly, right? Yeah, to keep your straddle and have insurance, you got to buy the guts, sell the wings. So that's what I would do on the trade. If you're dead set on that, at least you're financing the trade with the selling of some put and call contracts, and that'll help offset some of your risk. So I hope that helps. You're welcome, Joel. Yeah, exactly right. So, it's entirely possible. It's entirely possible it could be a good trade. If you hedge it, I would be okay with it. Bitcoin 88% correlated to the equity market. Yes. Maybe it was, but no longer. No, it is. I just showed it. Bitcoin has become a nearly independent beast of its own. You don't want to look at it as if it's a trading like a stock. Okay. It's all about the sentiment. We began the live stream off with this chart here, right? What's the sentiment of the market? It's optimism. It's extreme greed. So people feel comfortable with buying risk assets. So we're not saying that it's trading like a stock. Sure, it's a beast of its own. And I even said earlier that gold is a beast of its own. It's a value play. It's a store of value. People don't like it, but the fact of the matter is that you look at a long-term chart, it retains its value. Simple as that. Could crypto be the next thing? Sure, maybe. I'm an open-minded person. I'll watch the charts post the equity market sell-off. I expect gold to go down. I expect crypto to go down. The question is, which recovers first? Which recovers more rapidly? This is not a knock on crypto at all. Not at all. In particular, Bitcoin. We want to keep an open mind. That's all. Oh, back to ARM. We'll wrap it up with Trader Isaac. All right. So the question by Trader Isaac. Well, will it trade with NVIDIA? It's pretty easy to figure out. Let's take a moment and figure it out. My guess is yes. High-tech beta is going to trade together. So let's overlay this here above. Let's go to a weekly chart to get a higher level view of the correlation. Smooths out the noise a bit. There's not a lot of data here, as you might imagine, but for the most part, they're very, very tightly correlated at current 87% correlated. So, yeah, I would expect that ARMS is going to trade in whatever direction NVIDIA is going to trade post earnings. And this company has no PE. So definitely. So absent NVIDIA earnings, does this stock continue up higher? You know, looking at it as a standalone stock, I could argue, yes. It looks as though we're consolidating. We had a nasty sell-off. We got overbought. We're holding here. We're forming a base. So I'm not bearish on it whatsoever. Now, looking at it, because we know the XLK is rolling over. How does it look relative to the XLK? Not as correlated. They're only 62% correlated. Think about that. I'm very surprised to see that, but that's the fact. So this can continue up higher. All right, all. We are way over. Thanks for being here. Hey, folks, like, subscribe. You know the deal. The channel's been growing of late. It's been really, really nice to see a lot more engagement. So I'm excited about that. So if you're not currently on our email list, you want our best stock charts for the new trading week, enter your email address anywhere below. We have a 5-part video tutorial, my top 5 favorite candlestick patterns, linked below. Take advantage of it. And everybody have an awesome night, a profitable trading week, and I'll talk to you soon.